forwards and futures is, what we want to talk about in the context of risk management. Okay, so when you think about companies, one of the things that you have to look at is, how volatile is the stock. So one of the things that we talked about last time was, this notion of beta, right? It's a measurement of risk, and you can look at it and see the higher it is, the more risky the stock is from an equity market perspective. One of the metrics that we use, you can use to measure risk is the standard deviation, right? So if you buy a stock that has a high standard deviation, you're taking more risk than if you buy a stock that has a low standard deviation, right? You step back, you say, well, if I'm taking more risk, then I have to be compensated for that risk, right? So the expected return to the shareholder has to be higher. So the shareholder buys a stock that's more risky, they expect a higher return, right? So they expect a higher return, the cost of equity capital is higher, cost of equity capital is higher, weighted average cost of capital is higher, weighted average cost of capital higher, projects, the valuation of projects goes down, right? Which means that the whole value of the firm goes down when you have a risky stock price, right, that has an impact all the way through the valuation process. Does that make sense? So if you, like we did last time, you go out and you talk about, we talked last time about measuring that in the context of beta. Remember that? So we said that, if you recall that, and the expected return for the stock is the risk-free rate as proxied by a treasury bill. Right? Where that's the return on the market, risk-free rate, beta, right? So beta was that regression equation between stock market and your stock return, right? Go out to Yahoo, you can find them. We talked last time about why using those numbers can be problematic. It's always better to calculate it yourself, but so this is going to be leveraged by this factor, right? So that equation is going to be determined by really beta. These things are going to be the same for all the other companies in the market. But this is going to determine what this is, right? And recall that becomes part of the cost of capital equation, right? So what you can see is that risk has a direct impact on valuation. And you can let it flow back, right? We could write up the equation for WACC here. You draw a line down. You can see that, and you have your projects out here, which are being discounted by the WACC, right? And so if this goes up, all those things go down, right? Net present value on every one of your projects, if you're funding those through equity, are going to go down, right? Which means that it's harder to fund projects. Right? So you have a fixed amount of capital, all those NPVs go negative, then you're sitting there with a bunch of capital, right? You're not employing it within the business because the cost of it is too high, right? So firms not only try to manage the projects, they try to manage the cost of their capital, right? And so if that is a regression of the returns of your stock price relative to the market, right? Market's up, your stock price up and down, market's up and down. Do you have any control over it? Do you have any control over the returns of the market? Do I?
You can't control the market.
Can't control the market.
I mean, if you're big enough, theoretically, I mean, like when Warren Buffett goes out and buys a huge amount of stock, I mean, theoretically like that you could, but me and you, probably just small investors probably not.
It's going to be hard to, right? You may have some intraday thing, but you're not going to be able to internally you keep your stock price up or down, or you're not going to be able to do that, right? And in many cases, it's probably against the law. But there are times when you can have a buyback, and you can go out and buy stock, and you can announce a buyback, and you can try to manage it. But for all intents and purposes, it'd be very difficult to do it. And So what do you have control over? If you think about the equation, returns of my stock versus the returns of the market as measured risk, well, you can try to manage how risky your own stock is, right? You know, if you think about an income statement, what are the things that management has control over in an income statement? If we go down the income statement, you have revenue, what are you taking out? Expenses, do you have control over expenses? Yeah, you do, right? You can manage that. Particularly if you're producing something, you can hedge the cost of the raw materials, right? So if you think about your inventory, if you are producing, if you're converting scrap metal into, how does your business work?
We buy various metals from the public, and then we also do demo work and put off roll-off boxes to supply ourselves with our own metal. Then we process it. Like number one steel, we'll process it into 2-foot pieces so that it can go directly into a shredder. And then that's prepared steel versus just regular scrap. And that's really how we make our money, is by processing everything. If you bring in, you know, like today I ran about 9,000 pounds of copper. It came in as number 3 and went out as number 1 because I took the coating off of it. And then that has a price jump from, you know, say $1.80 a pound to about $3.50 a pound.
Okay. So your business would be perfect to talk about in the context of this, right? Because you're not doing a lot to it to get it to its final stage, right? So for the most part, you're collecting metals from the public, putting them into the stocks and selling them, or converting them to some higher quality and selling them in some other market.
Yeah, pretty much.
Yeah. So think about this business. Think about his business, right? What are the risks that he has?
Cost of those metals.
And he could buy a bunch of metal one day and then something happened in the market and the price dropped. Right? I'll give you an example of a company that I did this consulting project for. It's very similar business model that you have. They bought catalytic converters, right?
Yeah, about this.
Yeah, well, you know all the things in catalytic converter, right? So tell us the metals in there.
It's platinum is the main metal, and then there's 2 more with really long names that I can't pronounce.
Rhodium.
I don't know exactly what it is, but I know platinum's the main one.
Yeah, platinum's the big one, right?
Yeah.
And so, basically, they buy these things in bulk, right? And then they process them down, and they get the raw metal out of it. And they just sold, it was in Charlotte, they sold it to us. But they were like a large scale. But you can think about that, because once they buy the catalytic converters, they sit somewhere for a while, and they get processed. It takes a little bit of time for them to process, right? So what is that business exposed to?
Exposed to fluctuation. That's the reason with our converters, we only hold them for 2 weeks. We have 2-week turnaround on all the converters. Because the price fluctuation of that particular metal is really crazy.
Yeah, you think like, and this was, when I did this was during the financial crisis. So there were metals at a very, very high price. Some of them, you know, some of them were in, like gold went up. A lot of these metals just tanked in 2008. Like prices, a lot of these things just right straight through the ground. Okay? That creates risk, right, for investors. Because investors, if your company was publicly traded, the shares that I have would be based on the risk that you're taking by buying these things and holding them, right? So that's going to be reflected, right, in that metric up there. It'll be high. It's going to be higher and more risk that day, right? But on any given day, if the market moves a little bit, this stock is going to move more probably, right? Does that make sense? Okay. So more risk here has an impact on the valuation of the firm. So we're talking about what could you do to lower the risk? So even if we just thought about it in the standard deviation context, what could you do as a person that buys metal, right? Processes it and then sells it, and has some risk while you're holding it.
Those secure prices,
Yeah, you can try to lock in prices in the future, right? So
commodities.
exactly, you could try, you know, futures contracts or forward contracts, right? Right. So, for example, you know, if you just wanted to talk about gold, if you were buying gold, right? You could go out and engage in a futures contract and go ahead and sell it. So you go ahead and lock in your profit, right? So he could go out, he could go to the futures market.
That has its own set of problems too, right?
It does.
Yeah.
We're gonna talk about that. What are the problems?
We got caught in a situation one time where we locked in a couple 100,000 tons of product and couldn't produce it.
Right, yeah, exactly.
Yeah.
Yeah, that, yes, exactly.
Yeah, that's really, really bad.
Yeah. You over promise. Right, exactly. Right. You have to make sure that you have that. So you don't only want to be partially hedged, right?
Yeah.
You don't want to engage in enough future contracts to be certain that you can deliver it. Right. So let's talk about what a futures contract is real quick. So let's step back and talk about what a forward contract is. So if I go out in the marketplace, okay, you go out today, you go look for the gold. If you go to Yahoo right now and you look for the gold price, or you go out and look for the oil price, they're going to have it there, right? So if I do that, okay, you see this oil and gold here? So oil's 103.38. Treasury bills, you can go out and buy treasury bills. You know what those are now. But notice that this has this little thing here. November 13th, NYMEX. Okay? What does that mean? So if I look at this gold, if I look at this oil price and this gold price, click on the gold. Same thing, December 13th. What does that mean?
That's when the contract ends.
Yeah, if you go out and buy that, you're not buying it until then. That's a forward contract, right? So when you see these prices out there, those aren't spot prices. When I say spot prices that if I go today and I go out to the market and buy it today, that's what I would pay. What you're oftentimes quoted with these commodities is a futures price, right? So that's the price that you can lock in oil for you take delivery in November, right? So you're not going to take delivery of this oil until November, right? So that's the price of oil in November. Does that make sense? Yes, 13th of November. That's when you would have to take delivery. Right? You buy it, and so if you look at these specifications right here, you can do this on your own, but you go out and start trading these things, there's a lot of regulations with it, but you need to know the nuances. You take delivery of this in Cushing, Oklahoma. Right? You got to go there to their port and take delivery. It has some costs associated with it, right? So if you engage in this contract and you forget to unwind it, notice what this says here. Physical delivery. What does that mean? What?
You have to come get it.
And you got to go to Oklahoma and pick it up. 1,000 barrels of oil. So you got to go there and take delivery, right? Some of these things are cash settled. You just net out the cash. They don't deliver them. The reason that oil is because a lot of people buying this are going to refine it and use it, right? That's what most of the people trading in this. But so if we're thinking here, gold, oil, okay, we got the scrap metal business. How can I could go out and use these contracts to hedge the cost of gold, right? So if I go out today, I know that I can get 1322 in December, right? So if I've got a bunch of gold, so let's say, you take gold? So let's say you did. All right, we just assume that. A bunch of people get divorced, they bring you their wedding rings, you go. You're sitting on an ounce of gold, right? You can go out and you can sell it for $13.22 in December, right? You can lock that in today, or you could wait. Let's say you're waiting, to build up a certain amount. What could happen if he waits?
You could go up or down.
But if he locks in today, he knows exactly what he's going to get, right? Does that make sense? Does it cost anything for him to lock that in? right? And some margin things, you may have to post some margins, you know, there's gonna be some exchange fees. But in the context of swapping money, there's gonna be no money swapped, right? So he's agreed, if he was assured, he's agreeing to deliver an ounce of gold at that particular point in time, right? And what's he gonna get in return? He's gonna get 13.22. Okay? Now let me ask you something. Does that have anything to do with the price of gold? What the market thinks the price of gold is in December? This is where people have a false sense of how these work. So if I pull up oil here, yeah, you don't want to start trading these markets until you have a lot of experience. If ever. So if I look down through here, I can see oil delivered in November, December, January, February, March, all the way down. What's happening to the price? Notice what's going on with the price. Is it going up? Is it going down? Too much?
Goes down.
Why?
Just promising to buy at a further future.
So I can go out here and lock in oil. Look at this. I go into the future, it's farther and farther down, right? I mean, do you think oil prices are going to be higher in 2021 than they are today? Does the market think that? What does that? But notice there seems to be some regularity in which this goes down. It's not like it jumps down by $5 and then, right? There seems to be a process at work. Is there not?
Yes.
Something going on here. But you would think, right, that if these are forward contracts, it's actually futures contracts, that this would be what the market thinks the price of oil is going to be in January 2015, right? You would think that. Right? But it's not.
That's what they would get.
I'll show you, it has something to do with holding costs. So you have to, there's a cost of holding oil, right? And all these things are priced off of arbitrage arguments. And these aren't really priced that way. So you got these investment bankers sitting in these rooms and they're constantly buying and selling and they're keeping these things in parity, right? But there's a parity relationship that has to hold with these kind of things. Because if not, there's money to be made, and they will go out and engage in these transactions and make money. So let's talk about what that relationship is real fast, just so you've seen it before. Okay, so let's do a little math review real fast. So everybody's seen, we've done this before, right? You have the present values and gives you the future value, right? Everybody agree? Right? So that's if we compound one time. Correct? We have multiple year compounding. We can change this, right? Right? So in the first case, if we had, this was 12%, we'd have $12, that would be the future value. But in the second case, if I compound twice at 6%, I'm going to have something greater than 12%, right? My real rate of return is higher than 12. Is that right? Anytime you have inter-year compounding, your overall resulting return is going to be higher. Right? So in this case, it would be 1 plus 0.12 divided by 2 raised to the 2. That's still just for 1 year, right? There's still a t here that's not being written down. Correct? So we can calculate that for multiple t's. So we could say we compound every 6 months, but we do it for 2 years, 3 years, 4 years. And that's going to give you the resulting return, right? You can write it that way. And this would be present value. This is just, this is what the factor would be. Right, so we could write that factor and write it out. So what happens if this number goes to infinity? What does that term become?
Perpetuity.
This part.
Close to
Hmm?
1, close to 1.
No. It's an odd number. You've seen it before, though. I think, maybe. That's why we're doing this. If you had history, you may have not seen this before. In a while. Anybody know? No? Well, if you ever get bored, do it so they don't let it get very hot. But it's the E. You've seen E before, right? Euler's constant, 2.71828, and it repeats itself 1828. That's what it becomes, 2.71 basically, right? And that's important in finance because anytime that we build models, we always use this compounding in this way, right? We don't really use a model. You don't use this up here. Right? Particularly for stock prices. The stock prices wait to the end of the year to change? No, they're changing all the time. They're instantaneously changing. So you have to use compounding like this when you do anything with stock prices because they don't just wait till December 31st and change. So when the market's open, they're up and down. And whatever they did earlier matters, right? So you're saying that if you change this morning, if you change this afternoon, that is dependent on what you changed this morning, right? It builds on itself, right? I mean, there may be some information, but your next starting point isn't where you began in the morning, it's where you just left off. Does that make sense? Okay. So when we write returns, we can calculate them like this. So you're going to see this today. That's why I'm just reviewing it, because don't get scared if you see the E. All that is you're just taking this equation and saying that N is very high. Right? I think there's a document on Blackboard that goes through this. If you go, it's the present value review notes. I think it's like the first week. There's a whole document it goes to. And I show you how you go from a small R all the way up. And it matters. I mean, for example, when you get your bank statement, credit card companies like to do what? They like to compound daily, right? So if I compound daily, this becomes 365 and that becomes 365. That will be a higher number than if this is 1 and that's 1, right? So in fact, we're paying a higher interest rate to the credit card company because they compound more, right? So let's go back to where we were. So we see that there's some relationship here. We see that these values are going down. Right? We go to other pages, they'll go up. And it matters. The R is going to matter. We're going to talk about that in a second. But there's a process at work. And that process at work is not, it's not, wow, the market thinks that oil is going to be $1 or $2 in December. These prices are based off of what? You see they're coming back to what it is now. And you see that there's some relationship, and that relationship is based on the price now. Right? Okay? So let's just do a simple example. So this is a pretty simple relationship. Okay, S is the spot price. And F is the, I'm going to use the word forward here. is today, and I know what the risk-free rate is, I can calculate what the futures price is. It's very simple, and I'll show you why it's got to hold that way. For commodities, it's a little different because this R can be negative. Because there are commodities that cost a lot to store, like uranium. I mean, the longer you store uranium, the less you have. And it's not easy to transport and store, right? So in that context, you're paying money to store it. Ultimately, you're going to need it, right? But while you're storing it, it has a very high storage cost. Does that make sense? The same thing with oil. Is oil easy to store? Would you rather have 10 ounces of gold or 1,000 barrels of oil to try to deal with? But what about 17,000 bushels of corn? So what happens when you store corn?
Shelf life.
Do what?
The quality deteriorates.
Yeah, it starts to rot, you got rats eating it. Those things happen, right? So there's going to be some declining value of that as you hold it, right? So that's a cost. It has a cost. Some assets, provide you a benefit as you hold it. We could go back to the uranium example and say, well, you're smart enough, you could produce power while you hold it. So some things that do have a value that you hold it. Okay, so if I know what the risk-free rate is, in this case, we'll let it be 3%. So this is 3 months. Right. So I can easily take this and calculate what this is. Right? That's what it's got to be. Or alternatively, if I know what that is and I look at that in the marketplace, I can back out and calculate what R is. Right? And you can do that. You can take all these futures prices, back out your R, and you can calculate what that is for oil for 25 years. And you can figure out what it is and get an idea. Right? If you see fluctuations in that, then if you're a trader, you can take advantage of it.
What's 350?
That's the spot price of gold.
Oh, okay.
That's what it's selling for today. Okay? So I can use this to say, what is the futures price going to be in the future? So in the Allen scrap metal example, I'm able to lock in that gold today, right? In December, that's basically on the price of gold today, with some R there. Right? It's not what the market thinks gold is going to be in December. It's this equation. Right? And I'm going to show you what happens if this falls out of here. And we'll get if you're in the other class, when Jared comes, I'll get him to talk about, he used to do this with ETFs. Asking the ETFs, this ETF gets out of parity, you just buy a bunch of them, right? And these guys have books of $400 million they're sitting on it, so it's not me and you doing this, it's big players that keep these things in parity. And they do it all, they sit there all day, that's what they do. So imagine that you have this relationship. You look out and you find that okay, the futures price is higher than what it should be. Okay, let's say you go out and it's 355. All right. So immediately you can, sorry, you can take advantage of this, right? So how can you take advantage of that? And without taking any risk. I risk it all. Futures price is too high.
You should sell it if you have it.
Look, you don't have it.
Can you buy it?
You can buy it.
Is that at Deja?
You can buy it, and you can go out to the market and buy gold right now. This is for gold.
So we buy how much a day and hold on to it,
And,
sell it later.
yeah, so what you can do is, let's say you don't have any money. You go get a loan, right? These big banks essentially borrow at the risk-free rate. You know, all those investment banks became banks, remember, after the financial crisis. So they can tap into sources of capital we don't have access to. When you think about these things, you always think you always want to buy low and sell high, right? So you want to sell at the higher price and you want to buy at the lower price. Okay? So if you think about your initial cash outflow here, and then your final cash outflow, okay? What's going to happen here with the futures? What's going to be my initial cash outflow? No, right? Doesn't cost anything to engage in a futures contract. What's going to be my final cash flow associated with that?
Your interest rate from borrowing the money?
No, just the futures contract.
Uh,
So I'm buying low, I'm selling high. So if I'm in a futures contract, if I'm short the futures contract, what am I going to do at the end of this?
Go along and sell it.
Sell what? Do what? See, these are complicated things to think about. Right.
Physically get the long position and offset it.
If I'm short the futures contract, what's going to happen at the end of this relationship, 30 days from now, or 3 months from now? What's going to happen if I'm short? I'm out on scrap metal. I'm short the futures contract.
You're gonna lose value in money.
What's going to happen physically?
You guys have to go out, buy that gold at whatever price it is at that day and sell it.
No. I've got to deliver gold. Doesn't matter if I get it today. Doesn't matter if I get it 90 days from now. If I'm short the contract, I have to show up with the gold, right? So wherever we've agreed to show up and deliver, I've got to come with the gold, right? If I'm long the contract, I'm buying the gold, okay? So in this case, if I'm short, right? I said you're going to sell the high one here, which is the futures. So I'm going to sell in the futures market, and I'm going to buy now. If I buy gold right now, and I sell it 90 days from now, how much am I going to make?
$2.65.
You're gonna buy
I'm going to make 5. If I've got gold, right, if I've got money, if I've got $350 and I just go buy the gold, just deliver it in 90 days, and I've locked in $5,
I thought you locked in at $3.52.
no. This is just an example. The futures price is greater than what it should be. It is $3.55 and the spot price is $3.50. It's higher than what it should be.
Oh.
How do you take advantage of it if it's higher than what it should be? I'm just showing you what Jared would do. A guy with $400 million. What's he going to do as soon as this happens? His little computer's going to start flashing. It means he's got like 2 seconds to make this trade, right? So what's he going to do? You're traders right now. You got $400 million in money.
He will buy it right now at $3.50.
Hmm?
He'll buy it right now at $3.50.
Yeah, you either buy it and what?
You'll agree
And
to
then
sell
sell
it.
it
So you're
later.
going to sell it in 90 days for make $5. Is that a pretty high return for 90 days?
Yes.
On a bank that, yeah, I mean, that's right. Because in this case, he's not taking any risk. Right? Hold on, I'm not done. What's your question?
Well, does this have to do with answering your question about if you're short? You're saying just buy it. But before, when you're saying if you're short on the contract.
Yeah, so let's step back. Somebody doesn't have a piece of paper. We're gonna create a forward contract. All right, you got a pen? All of that.
So I don't think we're gonna make any money on this.
All right. So I'm gonna go see my metal man here. All right. We're gonna exchange this contract. No money is gonna exchange hands. Right? There you go. He's gonna sign it, I'm gonna sign it, and that says I have to bring him a certain amount of gold, let's say 1 ounce, 9 days from now, and we're gonna exchange that at 350. He's gonna give me 355, and I'm gonna give him the gold. Right? So now I'm in a legally binding contract. Unlike the options that we talked about last time, which were not, you know, an option, I would have the option to bring the gold, he would have to buy it for me. Right? This is a futures contract, in this case, a forward contract, so we now have a legally binding agreement. Okay? I am short the gold, he is what's called long the gold. So as prices go up, what's happening to his value? So if this gold goes to 356, he's got a contract that says he can sell it for 355, right? So what's the contract value worth? At least $1, right? I mean, what? $1, right? Yeah, and then, so that's what the value of the contract would be, okay? You discount it back and say, well, I know for a fact it's worth $1 9 days from now, but what's it worth today? Well, I discount it back. You just discount it back. And that would be what the value of the contract would be. Right? So, in this case, if I was Jared, and you came up to me and was like, hey, I'm gonna buy the gold from you at 355. I'd say, okay, so I can buy it for 350. Right now, and just store it, and assuming that the storage cost of gold is low enough, right? Then I'm gonna make $5. So what's not in there, storage cost? Okay? But you can put it in there if you want to. It just affects the R. So, we all agree that on the last day, I'm going to have what comes to me. What's going to be in my hand for my friend here?
Cash.
355. Right? All right. So let's say I'm poor and I go out and borrow the money. Right? I borrowed $350. Okay. So you're going to loan the gold. Oh, sorry. Alright. So you're going to go and buy the gold, it's going to cost you $350, right? Alright. And you're going to have a loan here, which is going to be money coming to you. And if you borrow that money and you do the calculation, you borrow it at 3%, you're going to have to pay back in 90 days exactly that, right? If you want to know where that number came from, that's it. It's just that. Going forward, that's what I would pay back if I borrowed $350. That's what I'd have to pay back in 3 months. Right? So the net cash flow from this is $2 per ounce. Okay? So Jared's out there buying, selling, buying, selling, buying, selling. So as he's doing that, what's happening to those two prices? They're converging on each other. Right? He's out there buying gold. As you buy gold, what happens to the spot price of gold? If I buy gold, the price of gold will do what? It's going to go up, right? Particularly if you buy $400 million worth, it's going to go up, right? So if I'm writing futures contracts, what happens to those prices? They're going to go down, right? More and more futures contracts, more and more futures contracts. Futures prices coming down, gold prices coming up, until we get to equilibrium, right? To the point where I'm not making any more money. And then what happens is that's zero. Does that make sense? The reason I'm showing you this is because if you're in a corporation and some fancy CEO says, well, hey, the price of gold, we're making these things, let's hedge it out Because the futures price, the forward price, is what the market thinks it's worth. That's not right, right? There's a parity relationship that has very little to do with what the market thinks the value of that thing is going to be in the future. It all comes back to today because you have these traders that are doing this, right? They're locking these profits in. Well, we got time to do that. You got to take. Believe me, that you just do the opposite. If this is the other way, you do the opposite and you lock it in. In that case, you end up, it's flipped, right? This would be negative, you end up shorting the gold, letting out the money, and it's going to be exactly the opposite, right? Again, there are traders that are doing this. These parity relationships are holding, right? And you notice that as you look out, right, you see that relationship because the R is negative on the gold because the cost of storing it's higher than the risk-free rate. Does that make sense? The cost of storing that is higher than what the risk-free rate is. Because the risk-free rate now is 0. Right? So it doesn't cost anything. So these guys that are doing this arbitrage, it's not costing them anything to do it. The cost is very, very low. All right. So everybody's with me? We can use futures contracts to reduce the standard deviation of our cash flow. And there's some videos online where I go through that. Does anybody watch the videos on the hot dog buns? You saw that, and you see that if you could, so if you're thinking about an income statement, right? So bringing this back, right? So let's think about what we're trying to do. We know that if this is lower, which is a measure of risk, so the value of my company is higher. Right? The value of my projects are higher, I accept more projects, right? My company is less risky. Okay, so the question was, what do I have control over in this relationship that can get the beta to go down? Right? Well, we got to the point where somebody said, costs. Right? And we went to a great example of cost. Your biggest cost is probably the cost of the metal that you buy. Right? Then there's some cost of processing. Right? So you're a slave to that market. Right? So whatever it does, your business is making money, right? Or losing money. Prices are fluctuating. So if I'm making tires, would it not be advantageous for me to look out into the market and try to hedge the cost of rubber? Or what if I'm an airline? Does it make sense for me to look out into the market and try to hedge the cost of gas? Or if I'm a gas station, like Exxon, would it not make sense to try to hedge some of that? So that I'm locked, I know exactly what my payoff's going to be in the future? Right? So I'm not, so well, what are you giving up? So if we're thinking about risk, right? If I'm hedging, if we just have a mini income statement here, I know you could have been in the class right there. Gotta leave. So, revenues, all. This is a very simplified income statement. Taxes, net income, right? This, we got our people out, our sales force, they're pushing the product. They're selling it. We're trying to do like Target and find the best things to sell, best location. And who else is getting the CPA here? No, you are. Okay. Well, do businesses not go out and try to manage what they pay in taxes? I posted an article the other day about how much money is sitting offshore because they bring it back, they have to pay taxes on it. So there's like tons and tons of money offshore that firms have in these subsidiaries. So the firms are trying to manage that, right? Less volatility with that, right? Lower volatility in net income. So if I graph the distribution of net income, it's going to be wide for some firms and not so wide for others. There's certain firms that are less risky, right? Like a utility, right? Why would a utility have less variation in its net income than somebody who produces like a restaurant or a scrap metal manufacturer?
Supply and demand, there's presumably always be a demand for
Say that
utility.
again?
Would it be like supply and demand, because presumably there would always be a demand for utility?
Yeah, let's take a water. Let's take Grand Stream Water and say which is like a mile down the road here.
And no competition.
They've got no competition. The first thing, right? That's the first thing that they. And when you're in an environment with no competition, what happens? I mean, if this goes up, what do you do? I mean, if this goes up, if the cost of producing water goes up, then what do?
Raise prices.
You just pass it on. Right? Just pass it on. Up here, when you have revenue with units sold times price, people just go up. Right? So, units times price gives me revenue. So if I've got some pricing power based on monopoly or whatever, or if I'm able to pass through the cost to customers, right? And this was a big deal for restaurants during the financial crisis, right before. Because all these raw material prices were going up. Beef was going up, wheat was going up, everything was in a bubble, right? So these restaurants were producing menus like every week. They would have to change their menus because the value, all those prices were going up so fast, right? So if you're producing menus constantly, customers don't know what things cost. You have much more fluctuation in this, right? And so if I'm an investor, I'm looking at your net income's all over the place. Does that mean I'm not taking more risk? Right? Because anytime that this is less than those two other things there, you're going to be insolvent soon unless you borrow money. Right? I mean, technically, if that ever, and so what's driving that? Well, part of it's how many units you sell, and your locations and all that, and your costs are another big driver of that. So you got to think about this conversation in the context of lowering risk. And so if I lower risk, what am I going to do? I'm chopping off the ends of the distribution, right? I'm giving up that home run year when gold prices skyrocketed. And I was fortunate enough to have a bunch sitting in the garage, right? Because if I'm engaged in the futures contract, I've locked in my price. As prices spike, I'm not able to enjoy that, right? So you're trading off the fact that you're not going to be down here, but you're also not going to be up here, right? You know exactly what you're going to get. Does that make sense? You know exactly what you're going to get. You don't have the high side. So net income becomes much more stable. And so when net income is much more stable, the likelihood that you default goes down. And the likelihood that you default goes down, the riskiness of your company goes down, and the riskiness of your company goes down, your value goes up, right? So there's some value to hedging. And tons and tons of firms do this. And they're out in the market doing these things all the time. Banks are hedged. You name it, if it's a large firm, it's hedging its raw material price increase against raw material price increase, particularly after coming through the recession. Right? Because if you had this huge spike and then they all just tanked. And so hedging that really benefited our company. So if you go watch that video, one of the things I talk about is, just a simple example, the hot dog manufacturer, right? Well, if you're producing hot dogs, what is your inputs?
Hot dogs and buns and all you.
Now, what goes into a hot dog?
Anything everybody else wants.
Exactly. And as that goes up, as the price of cattle goes up, the price of hot dogs goes up. Right? Okay? So, as the price of hot dog goes up, what do the customers do? They buy fewer of them, and then they buy something else, right? They switch to some other product. So they reach a point where you start losing you start losing sales. Okay. Does that make sense? So you see how you can go out into the marketplace, engage in a futures contract, lock in prices, reduce risk, increase value. So you could start at the end and go all the way back. So for example, if you had a list of stock prices and you had some indication of how risky you are, do you think the stock values are based on this? Net income, what net income you produce? So, you know, your stock price today, does that have anything to do with your profitability? It's almost completely driven by that, right? So, you know, creating more stable net income benefits the firm. And one of the things that you do have control over is cost. Very good. How on earth do I minimize this thing? I want to save this and then reopen it. Sorry. Okay, very good. Let's talk about options now. So, in the context of risk management, if you go out and look, you know, the CME website, you see all these futures contracts here, right? So, if I go out and I engage in this contract, one of the things that's going to happen is that the CME is going to act as an intermediary, right? So to go back to the Ford contract example with my friend here, if we go out and find each other and engage in this transaction, how do I know that he's actually going to show up with the money, right? So as the contract becomes more valuable, the likelihood that I never see him again increases. Right? I mean, you know, this could be worth $1 million. Right? And he can get on a plane and go to Barbados, and I never see him again. How would I enforce? How would I enforce this contract?
Collateral?
Yeah, you could ask for collateral.
Wouldn't there be a third party to ensure that that's paid?
Well, that's what we're going for. Yeah. So in this case, if it's just me and him, I would have to sue him to get him to. I'd have to go through the courts, right? I'd say I got a contract. He agreed to do this. I'd have to go through the collection process. So there's a lot of risk with a full contract, right? I've got to find him. But these don't exist. They're big, large banking entities that trade stuff all the time, right? There may be some. Well, for example, Chase just bought all the JCPenney stock from Ackerman. Did you see that? Yeah, they just bought it all. It was kind of a Ford contract. They agreed to do it, right? So there's specialized transactions that still take place in that market. You've got to have a lot of confidence in the person that you're dealing with. Right? And I have all confidence in you, but there's no risk, right? So one of the reasons why people use the futures market is because now I'm not necessarily dealing with my friend here. We're going through the exchange, right? And so one of the things that you have to do is post collateral. You have all that collateral posted. You have enough cushion. Actually, none of these guys did not go under due to financial crisis. But you know, think back to the contract. Again, as the contract becomes more valuable, right? The person losing money has a higher probability of disappearing and not in. But what the market will do, what the CME group will do, is they'll stand in if the person doesn't deliver. One of the other things that they do is they have a process called mark to market. Okay? Well, mark to market is, it reduces the risk in this transaction. So in a forward contract, we don't see each other again for 9 days, right? He goes his way, I go my way, I'm doing my thing, he's doing his thing. In a futures contract, every day they will look to see what the value of, what the value of this contract is and what the spot price is. So look at whatever the futures price is, whatever the spot price is. So as you lose money, you have to post money to an account, right? So if we lock in at 355 and today gold jumps to 356, right? Got to post it out, right? That's less risky than if we wait until the end, right? Does that make sense? But what's the problem with that? So if you're engaging in some futures contract, if you're a large firm and you're hedging way in the future, right, and you're posting money every day, what's happening? So you may have a momentary drop in the value of the contract, but you're trying to make a long-term hedging decision, right? You're trying to hedge over 3 years, but just over the last 3 months you've lost money. So what's going to happen? That's going to have a cash flow effect, right? It's going to start affecting your cash flows. So it doesn't matter if you're profitable in the long run. In the short run, if you're marking the market and you're having to post that margin every day, it's going to have an effect on your balance sheet, right? Does that make sense? Yeah, so there's a lot of examples of firms that have these long-term hedging positions that they're in, and then they're losing cash on it, right? And they unwind it, and then the market turns back around, they were right, and they end up losing, right? There's a whole list of those things I can send you. But it's something to think about. If you're trying to manage the risk of a commodity that you're using in your input process, the way that you do that will have a cash flow impact on you, right? And that cash flow impact can be real. All right, so I just want to give you that example. So we ended last time talking about options. We talked about real options, talked about value projects. I've got some examples of projects we can value later. So let's go through some of the basics of what options are and then jump into how to value them. So if I go out and look at these options here, talked about last time some of this terminology. So just like with this forward contract, I can create an option. So if I, in this case, I could write an option right now for this thing. So this is going to expire Friday. All right. Okay. All right. So I have an option here that I promise that I will deliver to you. Or I'm going to say, I will. Let's say I'll make this a call. I'm going to throw this out here. I will buy 100 shares from you on Friday of GE at $24 a share. This is going to float around in the marketplace. Okay. I will buy from you 100 shares of GE at $24 a share without knowing what the price is. How would you value that? If I came out and offered it, like a marketplace, I come out and offer it to you, what would you pay?
You compare with the spot price.
But what would determine the value of this? What are going to be the factors that determine the value of this? Because they're different from the factors we talked about in stocks and bonds and others. So if I think of a bond, what are the factors that drive the value of a bond?
Interest rate.
Yeah, interest rates and the probability of default. Those are the two things, right? Nothing else really matters that much. There's some other things out there, but the biggest thing is, are they going to pay me back? And what are interest rates doing? Same thing with stocks. What determines the value of stocks?
Who determines the strike value?
It's under contract.
Like what I'm thinking is, say like June 2014. Like
Oh, it's a standardized process.
Okay.
The exchange does it.
Okay.
How fine this is determined by how much volatility there is in the stock. So if you go look at Apple, there's gonna be tons and tons of strike prices, there's tons of them.
Yeah.
So that's determined by the market. So that's another example of not market, the exchange. The exchange is gonna go out and have these rules, right? Whereas if I go out and here, I could create this contract to do whatever I want. I could make it 2433. But this forces some rules on it. You know exactly when it's gonna close, and you kind of reduces the uncertainty about, what you're gonna deliver.
I'm just thinking of like, for example, like a company announcing a new product. Say, nobody knows that they're gonna announce this hot new product in June of 2014, but if you went ahead and did something like this and you said, I'm gonna buy 100 shares at whatever the set price is, and then 2 days beforehand, they announce this brand new product and the price like skyrockets.
Yep.
Is that?
You're thinking along the right lines.
Okay.
That's the first thing that regulators do. As soon as something happens, there's some big earnings loss or some new product, the first thing that they do is go look at who traded the options.
Really?
Right? These things are very liquid. If you look, they're not trading that much. So, but they're highly leveraged. So, if you take GE, what's GE? What many shares do they? 65 million, 35 million, let's see. 35 million, right? Okay? 35 million versus 30? There's a huge difference. So, it's a lot easier to look at this market and say, well, all right, why on earth did you appear today to trade 200 options? That's harder to explain, right? Particularly, when you find out that your cousin works for Tesla or whatever, right? And then that's how they get people. They go look at these markets.
It's like insider trading and stuff.
Yeah, insider trading. Trading on material and non-public information. Which in the old days, there was actually there was no law that would prevent you from doing that. It had to be the person that worked in it first. But a lot of that stuff has been, a lot of the rules have changed, so it's a lot harder to do that than what it used to be. Not that it still doesn't go on, because if you go and look at, if you look at most events, particularly ones that aren't just like spontaneous, like a new product coming out or something like that, or like the iPhone sales. Well, how did you know before? You wouldn't know, right? There's no way to know that before. But like
The Fed deciding not to reduce the taper.
Yeah, they do a really good job.
Look a minute or two before,
Yeah.
or 2 o'clock when the announcement came,
Yeah.
a minute or two before, and the market went right up.
Yeah, there was a case not too long ago where these guys that worked at Bloomberg, okay, they had their magazine, they were filtering things to the analysts before they were giving it out. So all those things matter, right? And these are the markets where people go because they're highly leveraged, right? And I'll give you some examples of that in a second. So in this case, remember now, we're at $24. We got a little piece of paper out here. I'm offering it to you for sale. Okay? So what are the things that are going to determine the value of this? What are the factors that will determine the value of this contract? The price has to matter, correct? So the price is going to be one of the factors. What's going to be the other factors, do you think?
Definitely the volatility of the stock price.
Exactly, right. So the more this stock moves up and down, correct? The more likely whoever's writing it is going to lose money. Okay? So if this is a call, right? I'm selling a call and you're buying it, you buy this from me, what do I have to do on Friday? It's a call.
That means we have an option to buy it from you.
You have an option to buy it from me. I have to sell it to you. Okay, so if I write this contract, I'm obligated to sell to you. If you buy this contract, you are not obligated to buy from me. So that's going to create an asymmetric payoff profile, right? A payoff profile is not going to be a straight line like it is for futures. So if we do the futures contract payoff profile, it's just a line, right? It's just a line here. You make $1, I'll lose $1. It's symmetrical. These are not symmetrical, right? Because there comes a point when it's profitable for you to engage in the transaction, and there comes a point when it's not profitable for you to engage in the transaction, right? So again, this is a call. Things are going to determine its value. You know that the stock price is going to matter. What else is going to matter? Volatility is gonna matter.
Time, if you had more than 3 days, it would be.
Yeah, so if I click over on these tabs, which we'll do in a few minutes, you know, if I go on those tabs and go out into the future and look here at this $24 strike price, those are gonna be higher. They have to be, right? If I write this contract and sell it to you, and I'm giving you a year, anytime between now and a year to exercise this, then that's gotta be worth more than if I give you till this Friday to exercise, right? So time has to matter. So the longer time you have, the higher the value of the option, right? The higher the volatility, the higher the value of the option. Okay? Stock prices matter, but what do you think that's leveraged by? So notice that the stock price for all of these is the same, correct? But the prices for them are not the same. The prices are going up for the calls here and as you go down the puts. Well, why is that? So time, volatility.
Would it be the dividends?
The dividends matter too. Why would dividends matter? But that's not what causes this up. Well, let's come back to dividends. What causes that? Why is this going up? Is the stock price going up? Is that right?
Because the probability of price being in a certain range is higher than other.
No, you're overthinking it. Strike price. So it's not just the stock price that matters, it's the difference between the stock price and the strike price that matters, right? Does that make sense? Yeah, so that's going to determine the biggest bulk of the value, right? For ones that are near the money. Does that make sense? So in your mind, you know that the option has got to be worth, a call option has got to be worth at least the minimum this is going to be, the minimum value this is ever going to have is the difference between the stock price and the strike price for a call, right? That's the minimum. But if not, you can engage in arbitrage, just like we showed with the futures contracts, right? If this was worth $5 and you were willing to sell it to me for $4, well, I'd buy it from you for $4 and go sell it to Karen for $5, right? You got $5? You frame it. That's on that, I'll sign it. Does that make sense? But it's going to have a higher value than that. That's going to be the minimum value. Remember, I told you last time these guys wanted to know the price for calculating that difference, right? So, dividends are going to matter. Why do you think dividends are going to matter? So what do you think happens to the stock price when the company pays a dividend? No.
Goes up.
No.
It's additional income. It goes down, probably.
It goes down. So on the day that the stock goes ex-dividend, right, the stock price will go down by the value of that dividend, right? So if it pays a dollar dividend, it'll go down. So if you're thinking about calls, if you've got something that's putting pressure, downward pressure on the stock, then that's going to have an impact on the value of the call, right? So if I'm paying a high dividend rate, that has a downward pressure on how high my stock price can go. Because if it goes up by $3 to pay a dividend, it drops.
So all that's factored into the strike price in the simulation based on the dates?
Yeah, you can put dividend yields into the model.
Right.
Yeah, dividend yield is part of the model. Okay? What are the other two things that are going to matter? What do we always talk about?
Industry.
Do I? What you say?
It's that industry.
The risk-free rate. Right? That's going to matter. Right? So you got 5 main things. Time, risk-free rate, stock price, and then, which is the difference between those two, and the dividend yield. Those are the things that are going to affect the value of the stock option. Now, if you want to talk about an option on gold or something like that, well, you don't have a dividend yield, right? You just leave that part off. It would be 0. But it's going to matter. So, for example, that's gonna, if you're talking about GE that has a high dividend yield relative to Apple, then it's gonna make a difference, right? That's why you see these swings in Apple stock price. And everybody seems unusually sleepy today. Yawn, 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 yawn. How you doing? What's going on? Why's everybody so tired? Is it hot in here? Is the heat in the room? You want to take a break? Yes, break time? All right, let's refresh our minds. I want to give you some idea of where we're going with all this stuff. So what you'll be able to do after we finish tonight is value these projects using these techniques. I've actually solved all of these problems tonight. What I'm going to try to do is when we get to it tonight, go over. So either we'll go over them tonight or we'll go over them next time. And that's what we'll do with these. So you don't have to do, it'd be nice if we don't get to them tonight, if you would just maybe spend a little bit of time reading them and thinking about them. They're not hard. They look hard. They're actually not hard. These are very simple problems to solve. They do seem, well, yeah, but we'll solve all of them. And if next time, if it looks like we won't finish next time, I'll record and put them online. But I would like to ask you, your next assignment will be something like this, applying the option stuff somehow. But I wanted to tie it back to why are you doing this kind of esoteric stuff? Because it matters, right? We showed, if you go back to last time, if you look at the real options document that we went through, if you remember, NPV underestimates the value of these projects, right? So, and most projects have some type of embedded option in them, either a growth option, a management option. And this gives you an opportunity to value those things, or at least a little bit of practice doing it, or at least understanding that, okay, this is my NPV, I know there's some other value there, right? And you go hire an expert or whatever to value it. But these are, just to start, I just wanted to get them out there. You're not expected to calculate them on your own. We'll see how far you get tonight and I'll determine what we do. Okay, so these are some of the terms we're going to use when we talk about American options versus European options. American option allows you to exercise the option. So in this contract, if it's for Friday, I can exercise it anytime between now and Friday. Okay? European option, I just exercise it Friday. I can't. All the options that trade in the U.S. are American options, unless you get into some specialized thing with some investment bank. They're going to be American options. Well, for example, Warren Buffett has a put with the some big, large investment bank. He has this big, huge put on the S&P 500, right? And it's worth tons and tons of money. I'm not sure exactly what the value is, but it's a European put. You can only exercise it at that time. So I'll be using, big C for American, little c, because if you think about American options and European options, when you're valuing them, if I'm giving you the option to exercise anytime between now and Friday, that's got to have at least the value of you just exercising on Friday, right? It's going to probably be more, right? Depends on what the underlying characteristics of the stock are. But if I'm giving you the option to exercise anytime between today and Friday, or just Friday, which one would you prefer? Almost always going to, there's no reason not to prefer the first one, right? So That's some terminology. So if you look at this, this will tell you just quickly in your mind, if you just look up here, what the value of these things here are on calls and puts. Right, so you can think in your head, right, we know what it impacts the value of a bond, interest rate, default probability, we know what value that impacts the value of stock, right, we looked at that before, risk, G, how fast is the firm growing. These are calls and puts here. So we see interest rates matter, right? There's no G, right? Default probability here, the exchange is taking that up, right? So what we see is, for a stock, as stock prices go up, what happens to the value of calls and puts? And if you think about this in your head, it makes sense, right? So if I'm long a call, if I own this, right? I have the right to buy GE at 24. This piece of paper the value has to go up as stock prices go up, right? Okay. Now that's the value of the piece of paper. That's what is worth to the person that owns it. But it's got to be the opposite for the person who wrote the contract, the person that what we call is written the call, right? It's a call buyer and it's a call writer. So if I go and look at GE and I go out and buy that contract, I bought the call, which means I belong the call, I own it, and whoever wrote me the contract sold it to me is short the call, or we say written the call, right? Okay. Their payoff is the exact opposite of the long call. So if I'm long the call, I've got a spreadsheet here. All right. So help you visualize it. So if you're looking, the purple line is long the call. And what you're looking at there is, you're looking at time value only. I'm sorry, intrinsic value only, the difference between the stock price and the strike price. There's no time value in that. So the way I create these graphs are, I say, if this is the ending day of the option, there's no time value in the option price, right? It's all intrinsic value. What is the payoff profile across the spectrum of stock prices, right? So what would the value of this piece of paper be? This piece of paper be, if this is Friday at 5 o'clock, 4 o'clock, across these prices. So I can graph the payoff profile in this manner, right? So if you look at that, again, that is the value of this piece of paper at expiration date, at expiration moment. Okay, so if I remember, if I'm thinking about right, this is a total value. Of the option. Some of this is time value, and some of it's intrinsic value. And I'll go through a calculation in a few minutes. Those graphs don't have any of this. They're all intrinsic value. They're, in the case of a call, would be what? Stock price minus the strike price, right? That would be the value of this piece of paper at expiration. Stock price minus the strike price. Or zero. So if you look at, and so if I look at, actually I have it down here. We can look and see, right? It's the maximum of the stock price minus the strike price or zero. So that's just calculating IV. The guys that calculated TV won the Nobel Prize, right? That takes calculus, it takes some pretty advanced mathematics. Well, I'm going to show you the process. I'm not going to have you plug and chug through the model. But it's a pretty complicated model. All right. So we just care about IV. And why do we care about IV? Because this gives us an idea of what our payoffs are going to be at expiration, right? So if we're thinking about hedging, thinking about risk management here, this payoff profile is going to matter. It's asymmetric. So there may be some cases where it's better for you to buy the option than it is to engage in a futures contract for it. Right? Because it's giving you options, it's giving you that upside. So if I go back to my distribution ad earlier, options give me an upside in some cases, whereas the futures wouldn't give me that. Right? So start thinking about this from a risk management perspective. I didn't pay anything for the futures contract, right? That was risk, that was costless to engage in. But the options got to pay. Okay? I got to pay for it. So there's going to be some cost. So if I graph out this purple line, if I go out and list the graph, if we look at GE here, the payoff profile for any of these calls is going to look something like that, right? There's going to be some stock price here, or the value of that piece of paper is essentially zero, right? Why is it under zero?
Paid a premium for that.
Yeah, because I had to pay for it, right? So that's why when I write out, you'll see this two ways in books. You see it, the maximum of the stock price minus the strike price of zero, or you'll see it as I got it written in, which is actually the correct way to look at it. Okay? Because if you graph that out, like they do in a lot of books, with their equation, both of the lines are on zero. These two lines will just be on zero, but that's not true. You paid something for the option. You have to consider that in the context of the analysis.
Well, then it would never, under that scenario, then the person that's selling it, the put, would never be benefited, they wouldn't be making anything. They don't have a downside, right?
Here's the other lesson of the day. That green line is not a put.
That's the short side of the
A lot
call.
of people,
Right.
A lot of people make that mistake. Just like with the futures.
Right.
The puts are over there. Yeah, and a lot of people think that. You know, when people first start getting in the market, they make that mistake. A put, which is the right to sell somebody something, right? So so if I buy a put, I have the option to put it on my friend here. Right? I don't, but he has the obligation to buy it from me. Right? He has the obligation to buy it from me. I have the option to sell it to him. That has a different payoff profile than the opposite of a call. Right? So in a call, so let's look at this and we're thinking about risk. This whole thing's supposed to be risk management. So I'm looking at that payoff profile. Purple line's good. The most I can ever lose is what I paid for the call. Right? Never lose more if I buy a call than what I paid for it. Because if you look at the payoff equation, it's the max of those differences or zero. Because you're never going to engage in you're never going to execute the contract if you're going to lose money, are you? Yeah, so you're bounded at zero. And then you're bounded at whatever you pay, so that's why I subtract out the C. Because you could have paid $10 for the option or $5 for the option, but it matters. It matters to you. Okay? So, if you graph this, in these notes, you can practice this at home. So you can take this and graph it out if you want to. Right? It'd be good for you to go through this and actually do it, so you understand what is going on in that graph. You take these notes, look at what I did here, and then practice it. That way you get a better idea of what the payoff profiles are, what the symmetries there and the asymmetries there. Okay? So, if I'm long the call, somebody's written it, they're short the call. Right? Okay? Their payoff profile is just the exact opposite of my payoff profile. For every dollar I make, they're going to lose $1. So what's the maximum that a person that writes a call can ever make?
The premium.
Yeah, I mean, if you write a call, you have a very limited upside. What is the upside? Huh? Do I?
I'm guessing.
What did you say it was?
Is that your value goes up with the stock price?
No, it's not. It's just what you sold the call for.
Okay.
It's capped. So, if you write a call, the only thing you're ever going to make out of it is what you got as the premium. You go out in the market tomorrow, open up a stock trade account, write a bunch of calls, you're going to get money in, right? That's the most you're ever going to have. You're never going to make any more than that. Right? What could you lose though? What does that line stop?
Unlimited.
Yeah, that has no
The price
limit.
can go.
Yeah, I mean, the price can run on you. I mean, the probability that the stock market goes up 1,000 points tomorrow is pretty low. I don't think it's gonna happen, but if it did, what would happen to your position? Yeah, so you gotta be careful when you're doing these things. I mean, you gotta think about it. So if you're gonna deliver, if you can deliver a certain amount, if you don't deliver that amount, there's ramifications, right? I mean, you gotta go in the market and buy it and then deliver, right? So if you go out and buy a bunch of futures contracts, or, sell a bunch of futures contracts, or you're gonna deliver something, that means that you have to go out and buy those things if you don't have them. You don't have to have them. You can go out and you can play the market. Same thing here. You can write covered calls. You can have the stock. So, in that green line, I could have 100 shares of GE. I can go out and write a call option on top of it. That generates extra income, right? But what's going to happen as we go forward when the price goes up? They're going to call it for me, right? I can either have the 100 shares, or I can just go in the market and buy 100 shares. Doesn't matter. The payout profile is going to be the same here, right? Well, it doesn't matter. If I have the 100 shares, I have it. If I don't have the 100 shares, I don't have any money. Then I go bankrupt or whatever. Yeah.
So how much would you make if you sold like 100 shares? If you made a call on 100 shares of GE right now?
Well, it depends on what the price is on Friday. So it's all depending on what the price is on Friday. Right. So the value of this on Friday afternoon is going to be stock price minus the strike price or zero. Now, what happens on Thursday? The value of the option is not that, right? Because on Thursday, that is not zero. The time value is not zero on Thursday. It has some positive value. There's something there. So if you go back to how we started, there's 5 things that matter, right? Again, if you consider stock price, strike price as one item, there's 5 things. Right? Well, 2 of those determine the intrinsic value. S and X. Right? That's how we calculated it. Stock price minus strike price. Or, stock price minus strike price, pattern -1, or strike price minus stock price, that is for a put. That's the opposite. And they're all in that document. But this has some value on Thursday. Right? Because the day left. What is it going to be? What is it determined by? What determines TV on Thursday? Because IB is set. It's just X minus S for a call.
The price on Thursday?
Nope. That's in the IB. What matters?
How many people exercise the right to call?
Amount of time left?
The amount of time left,
They just come
the R,
to volatility.
and the standard deviation. Right? The biggest one of those things, if you're just one day back and you're eliminating T as a variable, would be the standard deviation, right? I mean, if I'm on Thursday and I want an option in Apple, and I want an option in GE, and I've got 1 day to go, which one of those is more likely to have some kind of like 3 or 4% move? Apple or GE? Apple, right? So it's the time value has to be higher, right? So it's a function of risk, and it's a function of time, and it's a function of interest rates. But interest rates aren't going to matter on 1 day. I mean, that's not going to matter that much, right? Dividend yield's not going to matter unless they're paying a dividend. So assuming no dividend, that's not going to matter, right? It's the 2 things that are going to drive that play together are time and volatility, right? Does that make sense? And so if I go out today, I can calculate. So if I go to the GE option, I can calculate. Okay, stops at 24.28. Strike price is 25. What's the time value? And make it easy. The yellow is in the money, the white's out of the money. And when I say in the money, out of the money, that's when the stock price equals the strike price. Okay? So anytime that there's a positive value to the options, is yellow there. Positive intrinsic value. So what is the time value of this option? $25 strike price.
176.
It's in between 1 and 2 cents. We usually take the midpoint of those two. A penny and a half would be what I would say the time value is. Right? That has no intrinsic value. Why is that? If I subtract the stock price from the strike price, is that a positive number? It's negative, right?
Yeah.
So remember my equation was the max of the difference between the stock price and the strike price, or zero. So that's how you beat that. So if I read this, the way I read it would be the maximum of these two variables. So either it's this or it's going to be zero. So in this case, if the strike price is higher than the stock price for a call, right, the higher value is zero. So it's just going to be zero, which means that, you know, this, you know, intrinsic value is zero, so everything has to be time value. And our brains would say, okay, well, yes, that's right. It's time value. We'll call it 2 cents. It's 2 cents, right? So we got a week. You know, I don't think we're going to get to 25 with GE. We might. It's up today. Never know. Okay, so if I go out, see if we can find one at a $25 strike price. There it is. Okay, so January 2015, right? Year and 3-4 months from now. Why does it say $1.67?
Are they adding because of the length of time?
Okay, what's the intrinsic value of that?
No.
Zero.
You sure?
The difference between
Yeah, so if I subtract
25 and...
Yeah, 24.25 from 25, is that a positive number?
It is, so we don't take zero.
No, it's not. It is negative.
Aren't you taking it the other way?
It's not.
Okay, is it strike?
It is zero. It's the same. The only thing that changed between that and the other one was the time, right? The intrinsic value is the same for both of them. It's zero. It's the same. They're both zero. The one is 2 cents, and the other one was what, 167? Okay. So, all right. I go through my factors in my head. Dividend yield's the same between all those. Interest rate's the same, right? Volatility, it's the same thing. The only thing that's different is time. So what you see is that options that have longer time periods have higher prices. In this case, I've got a year and some months. In the other case, I got a week. So that's a factor that matters, right? And that plays into with standard deviation. So if I was to go over and go to Apple, you know, if you go out with Apple like that in a year and a half, you're going to have these massive prices for the options, right? Because who knows where Apple's going to be a year from now? Does anybody know? I mean, it's been like 800s, back and forth. It's all over. I know where BlackBerry's going to be a year from now. I have no idea where Apple's going to be. That thing. Okay. Oh, wow, up 5% today, great. That's like $100, I guess, last couple days. All right, so let's see, where are we at? Flatbed's gonna go private. All right, we're down to what, 390, back up to 490, and what, about just a couple months here? Right? Lot of movement, lot of volatility. Right? But if you're writing options, would you rather write options on Apple or GE? Which one has less risk? Which one has less standard deviation? Right? Right. So let's find one. Okay? Let's find one that's, the problem is making sure that you have a strike that's over there. Okay. So 480. Let's see if they've got a strike out. All right, this is January 16th. That's even farther out. 480. All right? All right, 90 bucks. All right. And down to 480 here, and we're at $13. Right? So it's much higher. Okay? And see, but in your mind, here's something you need to think about. Okay? It's what we call time decay. So if I'm buying an option that's $90, that has a $10, essentially a $10 intrinsic value right now. The rest of that $80 is going to be time value, correct? So that was the Apple's at $490, the strike was $480, so it has an intrinsic value of 10. So the other $80 is all time value. What is happening every day? What is happening as I approach?
Time value is smaller.
It has to. What does it have to be on the expiration date?
0.
It's got to be 0. Right? So unless the stock becomes much, much more volatile, it's going to decrease in value every day. The only thing that can change is the volatility, right? So what I want you to think about, again, we're going back to what we were, our original conversation here, is how those things impact the value of an option, right? Because these things are going to matter. And if you're using options as risk management tools, those things matter versus the things that matter for a futures contract, which are different, right? Futures contract, we just showed you that you can go out and look, and it really, because of the parity relationships, you've got interest rates that matter, initial price matters, but you lock it in, right? And then you just have the price, and whatever you agree to construct. Okay? This has other factors that matter, that will determine the value of the option. Right? You can always make, you can go out and exercise the option, you can always make the difference between the stock price and the strike price for a call, right? You can always do that. Any given day, you wake up, you go and exercise it. Well, why would you ever do that, right? Because unless it's expiration day, there's always going to be some time value, right? So that is always going to be larger than this, unless you're at expiration day, right? But there's always some time value. It always makes sense for me to sell the option versus exercising.
So it'd just be like if you needed liquid assets quickly or something like
Well,
that.
you just got to sell it. Right? And yeah, unless you're like imminently going bankrupt or something. But then you could go to your broker and say, look, you can work out a deal, and you can borrow money, or on any given day you can just do the opposite and lock in too, right? So one of the things that you can do, who in here has a hard time going to sleep? Anybody? Just you? Nobody else? All right, tonight, when you're in bed, thinking about the sheet counting, go pull the spreadsheet up. You can see what all these payoffs look like if you start putting them together. Right? So again, in your head, we're talking about risk management. Most of the time when you're managing risk with these things, you have some combination of these things that limit your payoffs. Limit your payoffs in this case. And they've got all kinds of interesting things like strips, straps, straddles, condors. Yeah. I did not name these, but aggressive Wall Street traders did. You can know what's on their mind. But yeah, I mean, just take a look at it. There's all, you know, you can put these things into different combinations and make, you know, all kinds of shapes. And, you know, you name it, and it's out there. And you can flip that. You can have different payoffs. So you can, you know, you can think about this from a risk management perspective. You can limit here. I mean, in this case, you're limiting how much money you can make. You can make money in a small window. You can have the opposite, like you saw with a straddle. You're going to make money at the stock price. So again, in your head, think about, why am I doing this? Why am I engaging in this? You know, and there's lots of different ways that you can put these together. Okay. So again, call out. This is no time value. That's the payout profile. Short call. Right? That makes sense. So for a put, so the key to that green line is no, it doesn't stop. It keeps going. Right? Okay. So a put, you have it looks a little different here, right? Because now you're switching the S and X in the equation. Now it's X minus S. So if you go look at it, and you can, again, like I said earlier, you can practice with these. And it'd be good for you to come in and like, for instance, with this put we have, then draw it out. Show yourself what matters here, right? So in a put, if you're looking at this, notice again we have a symmetrical relationship between the person that buys the option and the person that writes the option, right? And their payoffs are different, but they're symmetrical. And so as one loses $1, the other makes $1. All right. So in this case, if I'm writing the put, what's the maximum I can ever make?
As high as the price would go up.
No.
The premium, there you
Well,
go.
that's the yellow line. So where does it go? How high does it go? It's just the premium. So again, in your brains, like the only thing you're ever gonna make, you go out at night, get crazy, you start trading options, you start writing options, the only thing you're gonna make is what you sell it for. There's no upside past that. Okay? You write a call, you write a put, the most you're gonna ever get out of that is what you just got for selling it. Okay? In one of those cases, you have unlimited risk on the bottom. So as you look at this, keep in your mind that you can go out and sell this, go out in the market and try to sell it to lock in profits, but you can also just engage in the opposite transaction, right? So if you're long on put and you don't want to sell it, you can engage in the opposite and they'll cancel each other out, right? So if I add these two lines up, it's going to be 0. Does that make sense? All right. So notice that this payoff looks like this. Right? Which one of these is long, which one's short? Which one is this one? Which one's capped? Which one has a cap on how high it goes?
Yellow.
Okay. That has to be the rider. That's one of the ways to think about it when you
So
see
the
it.
rider always, the most they can make is actually the premium that they charge
Yep, that's it.
for the option.
That's it.
And then whoever buys it can either lose or gain unlimited amount.
For a call, for a put, the most you can ever make is what? So if I, you go out and buy a put, why is this red line going to hit over there? Because a put's going to make money, it's X minus S, so a put's going to make money is what happens? The stock price goes down, right? Okay, how far can it go down?
To 0.
Can't go past 0. So that's why you're bounded with the red line. You're bounded that your payoff is going to be X minus S, okay? And minus whatever you paid for the put. So the most you can ever make is when it hits 0. Right? So, your strike price minus 0 and then minus what you paid for the option. Okay? Same thing. You go out and buy an option. You pay a high time value. What's happening to the time value every day?
Small premiums.
getting smaller and smaller and smaller. And there's a metric that exists to measure that. I mean, we literally have a class where it takes all semesters to get to the point where you can calculate that, right? It's called theta. And it's, you derive the Black-Scholes model, then you take the first derivative of it with respect to t, and you have it. That's what it is. But that's way outside of what we want to do with this. I will show you the Black-Scholes model. But I brought you a calculator. I'm going to calculate it for you, make it easy. So we'll look at these shortly, but yeah, you can just use this calculator and it'll calculate for you all these things here, right? So you can know if you're selling these, and again, banks, institutions are engaged in these markets constantly. So that's just put that up there so you can see when you put a long call in with a long put, the payoffs look different, right? So that in this case, you're thinking in this case, well, I'm going to make money if something either really great happens or something really bad happens here, right? You put them together, you're not going to make any money if things are quiet, but if there's a big, let's say Apple, right? They have really good sales or they don't, right? So it's not you're not playing any direction. You just know, you just want something really good to happen or something really bad to happen. And you're going to make money here, but you're not going to make money in the middle. So again, think about these things, putting them together so you manage risk. Okay, well, we won't get to the Black-Scholes model. Well, we won't arrive it. So let me tell you what the pieces are. You already know the pieces. What are the pieces of it? What are the 5 things that we talked about? I didn't use the, this doesn't have to do anything with it. Yeah, I mean, all the things that we've already talked about, except in this case I used K, and I had actually to fix that. The K is just the strike price. You have the 5 things that we've already talked about. Time, you see time there, right? You see volatility there. You see the strike price there. You see the stock price there. You see interest rates. Is there anything else in that model?
Is that E number?
Yeah, you got E. Yeah, but as a factor, outside of mathematical operations, those are the 5 things that you have, correct? So from the context of, for me in this class, because you're not going to model that, but you need to know that what goes into it, right? And it's those 5 things. And you can change this for dividend. There's a way that it's pretty complicated, but you can add dividend yield in. And if you want to practice this, we do this at the undergraduate level. We make you calculate that. It's actually not very difficult to calculate. It's essentially, you can take a log and do an E. You're pretty good, right? And you let Excel do you can let Excel do the norms this thing. But if you pull up, the Interactive Brokers has a pretty good Black-Scholes pricing model. I've got one I created that you can use if you want to. You can use either one of these. But it'll calculate for you the price of a call and the price of a put, right? And I've had students go out. You can go out in the marketplace and you can play around with this and see how close it is to what you find in the market. Mine does not have dividends in it. I think Interactive Brokers, they have a dividend yield in there. I didn't know mine that way. I can make that bigger. I don't think I can. But what it will do for you is calculate what the value of a call is and what the value of a put is. So you can just put the numbers in there and get it. And these will be close to what you find out there. Right? One of the ways that you can use this is that we know what the market thinks that the value of the put and call. So we can reverse engineer this, right? So let's say I want to know what the market thinks the standard deviation is for the S&P 500 over the next year. You ever heard of the VIX? You have. Right? There's a metric out there called the VIX, and what it measures is what the market, what the market thinks the standard deviation is gonna be on the S&P 500 forward look, right? 30 days forward look. You can go 30, 60, 90. Is that important to know? Yeah, I mean, that's what the market thinks risk is gonna be going forward, right? You hear a lot of times, oh, the VIX spiked because, you know, markets get a little crazy and the VIX will jump. It's a gauge used, they call it the fear index. So if you go and look, Google fear index, you're gonna hear VIX. And if you hear VIX, what the VIX is that they take these and backdoor into the standard deviation, right? So if I have these pieces, I can tell you what a call is worth. But if the market's already told me what the call is worth, then I can backdoor back in and ask, well, if I take an S&P 500 option contract, right? I know it. If I go out in the market, I know what the risk-free rate is, right? I know what the stock price is. I know what the strike price is. I know what the call and put price is. So I can put those variables in, and it'll tell me what the market thinks the standard deviation is going forward. That's valuable to know, right? That tells you what the market thinks the risk is forward-looking. I mean, that's something you want to know, particularly if you're trying to manage risk, right? If you're a risk manager and the market is telling you, well, we think that the volatility is going to go from 20% to 40%. That's valuable information. Yeah, so you know, you can look. I don't know. Well, there's a ETF that trades like the. Yeah, so this is an ETF, an exchange traded fund that derives its value from the VIX. All right. So this is not the VIX. This is a financial product that derives its value from the VIX. And the VIX derives its value from the implied standard deviation from a S&P 500 options contract that trades on the marketplace, right? So this value is based on what the market thinks risk is 30 days forward. Does that make sense?
You say so.
And some of these things are very complicated. But if you look at it, you know, if you look at this, you know, notice how it goes down. Why does it go down like that? Now, what was going on back here?
Stock market was really bad.
Yeah, the reason it stopped is because it didn't exist beforehand. There's a tracking indicator for the VIX, but I don't know what it is. It might be STAR. I'll look it up in a second. But notice what's happening here. This is good for us, right? This is telling me that, you know, things have calmed down quite a bit. A lot of risk back here, a little bit of risk here. This is a good indication for the markets, right? This is showing you the markets don't think there's anything crazy that's coming down the pipeline. Notice what happened in October. So it'll happen this October. They'll fight. There won't be a budget. It'll probably have more risk, but that happens. But they'll probably spike here in a little while. This is the ETF. There are ETFs that derive their value from. Oh, here we go. If we go back, this is going to have a longer time period. We're up today. Okay, you see where it was. You see where we are now. Okay. I'll win this match up here. Right? Spike, comes back down. So what does that number tell you?
Market doesn't think it'll fluctuate more than $14.
That's an implied standard deviation.
Oh.
It's just giving you the standard deviation. And why does that matter? So if I come back here, and I'm at an implied standard deviation here during the crisis of 60%. All right? All right? I'm at an implied standard deviation of 60%. Right? One of the inputs of the Black-Scholes model is standard deviation. Right? So if I change this to 60%, what's going to happen to that C? Huh? Go up? What's going to happen to the P?
Should both go, right?
They both are going to go up. They went up by about 4 times. Okay? So mentally, let's think back. So if it's 4 times as high, and I bought them in 2009 or today, okay, you know that the value goes down over time, you have a lot of risk here buying this, right? Because it has to lose more value than if you'd have bought it for less, right? So if you're not buying options in 2009, you still hold them, their values have declined, right? And most of that, if the prices didn't change at all, most of that decline has been what? It's been the time value. Because in that option, you've got three times the time value at 60% volatility than you do at 15% volatility. Does that make sense? So when you engage in these things matter. Because the inputs from, this is going to matter. Right? Everybody with me? On how to calculate? If I gave it to you, could you do it? With your eyes closed? It's actually pretty easy. But the key is that you know what the inputs are, right? There's 5 inputs. They're not the same inputs for bonds. They're not the same inputs for stocks. They're not the same inputs for futures contracts. They are completely different. And it's paramount for you to understand why those 5 things matter. And really, if you go out and you use these to manage risk, you really got to understand, these relationships here. You got to have a good understanding of, and you're right. So standing increment, they both go up. But if dividend yield goes up, call values go down. Right? We talked about it earlier. Call yields go up, pay out higher dividend, higher pressure on the price to stay low. So you can look at the others. Time too. Time is something that it doesn't. The longer you go out, the bigger the impact it has on calls and puts. All right. So take this document and see if you can work. At least draw these graphs, right? And see if you can do some of these things. If you can take, for example, when I go through the Black-Scholes model down here. For example, you don't have to do all this. It would be nice if you would at least take these things and type them in just type them in there and see what you get, and think about it for a second, right? You need to go through this and kind of get an understanding of time value. What I'm graphing here is, this is the total value of the option. This is the intrinsic value, so the difference is the time value. You can kind of take a look there to see, right?
The calculator will give us the same price for European option and American option?
No.
Or the calculator will use the type of option?
Yeah, right here. That's why I'm limiting. When I talk about this, I say European call. European put. I'm limiting that into the conversation. And so if you open up this and use my calculator, this calculator, yeah, Black-Scholes model, no dividends. And so you got to use the right model. Right? So I will give you the parameters. So if it's got dividends in it, and it's an American, you have to use this other calculator. You got to pick the right calculator, the right method. That's kind of outside of. That's a whole course. But it matters. It does. Whole course. You can also value these things using binomial trees. So, and I'm not at all getting into that. There's some notes. And if you, again, who's got the insomnia? I've got a whole set of notes that you can go look at here that goes through the whole process. Right? You can go in there, you can derive all this stuff, all you want. But and I can help you if you want help with something. Come see me. I'll sit down with you because it's going to that's going to blow the tutor away. Like he just right. But this stuff he can help you with. That stuff he can do. But that other stuff, that would be something I would come back to later. I did want to pull this up real fast. And it's getting warm in here, so we'll go in shortly. But the Black-Scholes model, one of the reasons why I use the E was because we deal with continuous time, right? So one of these is a randomly generated series, and the other one is the S&P 500. Right? So how many people in here thinks that the blue line is the S&P 500? What do you got? How many people think the pink line is the S&P 500? I think people are just like tired and hot.
Purple and blue. Okay.
We don't see no
Or
purple.
this is purple, or you pink.
I think the more by the tall one is S&P 500.
All right, this is the S&P. Does everybody kind of agree? Yeah?
No. It's a-
This is random? You think so? Well, let's find out. So if I type in a value here, the blue line is the randomly generated line, right? I just wanted to show you that because the models that were used to derive the Black-Scholes are based on these assumptions, right? And I always put that up because people, they kind of poo-poo on the models and they say, well, those don't work. Well, they do, and you bring the math back. You can't tell the difference, right? You cannot. It's completely impossible for you to tell the difference between those two lines. And that math that I use there is the same math that we use to derive the Black-Scholes, and it's a drift and stochastic process. But I just want to show you that because people are always amazed at how you can't, right? And you get a lot of industry pushback for these things. But if you go out and you go out to the stock exchange and pull prices and type them in here, you'll see they're pretty close. Because what the analysts use to write those contracts, most of those contracts that you see up there have been written by large financial institutions. They're using these models. Like Jared, they had an internal model inside that would value these things, right? So they're using these, just like the big guys are using those arbitrage relationships to hold the futures in parity. They're doing it. So you'll get a lot of pushback. Well, that's just a model. Well, if you go out and look, it's how it works. Because the large financial institutions are holding those things into parity. Everybody good with this? At least you understand the basics of what a call is, what a put is, written call, written put, those four things, right? Very good. So let me just open up this document real fast, and we'll go through those problems next time. But what we have here is there's just a set of problems I pulled from Philip Davis is on the CXQ committee. I know him very well. He's got a very good book on valuing real options. But the only thing you need to know to solve these problems is the little PowerPoint I gave you last time. And maybe what I'll do is I'll do a little video on the first one, and you can try to see how far you can get with the other ones. But all you're doing is you're just thinking about, like we talked about last time, you don't have point estimates. You have a distribution of outcomes, right? So if something has a 50% chance of happening and a 50% chance of some other outcome, you just have two columns of numbers and you just multiply them both by 50%, right? So think about it in the context of the tree. I have solved them, and so we'll go through them next time. But just to show you real fast, so like when we built our first models, when you took the cash flows and then you discounted them back here, all right? So if you're thinking about doing a tree in Excel, just use two columns, right? Remember what we talked about last time? Product makes it or doesn't, right? In this example, you have a world where there's going to be a tax or not, like at the beach, like you have a hospitality tax or you don't. So do you build a hotel or you don't? So think about it, do your math in different columns and then bring it back together at the end, okay? This is advanced stuff. I don't expect you at all to have this done next time, but I want you to think about it because I want to show you how you can use these techniques to value projects, right? To enhance the value of your company or the company you work for. So this is, those are kind of like trees, but there's also some questions in here about Black-Scholes. So they ask you to do this stuff with Black-Scholes. So you can use the Black-Scholes model to value these. or you can use the tree, the way we did it last time in my little PowerPoint, right? Where you have to draw out the trees. Right? So just draw them out as columns. So in your mind, think about those columns as probability distribution. That make sense? Okay? Good. Well, let's get out of here.